Welcome back to the Deep Dive. Today we are strapping on the intellectual helmets, so to speak, and plunging into the massive, often invisible, but really profoundly important world of financial market infrastructure. We're talking about the technological plumbing of global finance, specifically this irreversible electronic shift that is fundamentally changing how trillions of dollars in fixed income products and derivatives are traded every single day.
It is a highly technical area, absolutely. But for our deep dive today, the underlying story is actually pretty straightforward. Efficiency is winning out.
Right.
And the cost of staying manual, using phones and chat, it's becoming punitive. So we're focusing intently on Tradeweb Markets, Inc., ticker TW.
TW, okay.
Yeah. We've compiled a formidable stack of analysis on this company, and our mission today is really to understand precisely why Tradeweb is positioned not just as a participant, but as a premier operator, a true leader in this necessary modernization of these huge markets.
And the core investment thesis, the hook, it seems really compelling because it's so strategically clear, isn't it? Tradeweb has built this incredibly robust, highly defensible business model.
It really is.
It's anchored by this historical dominance in the massive rates market.
Yeah, exactly.
That seems to be their cash engine.
It's that foundation.
And now they are aggressively taking the cash flow from that stable base and funding this highly successful, very focused expansion into the credit market, which I guess is where the future growth runway looks longest.
Precisely. That's the narrative. And this whole operation, it's built on, well, what they argue is technological superiority and really world-class financials.
Okay, so what does that mean, world-class financials?
Well, when we talk about their financial profile, we mean things like industry-leading margins, consistent double-digit revenue growth even through different market cycles, and formidable free cash flow generation.
Right.
And just to give you a snapshot of their sheer scale, they connect over 3,000 clients. These aren't small players. We're talking the world's largest asset managers, central banks, hedge funds.
Wow. Across more than 85 countries. They're facilitating efficient price discovery and execution for some of the most complex assets out there. It really makes them a foundational piece of the modern global financial economy.
That's a powerful introduction. Let's start by dissecting the engine room itself. We need to unpack this multifaceted business model because, as you said, it's the diversification that seems to provide real resilience against the inevitable volatility of financial markets. It's not just one big trading revenue bucket, is it?
No, absolutely not.
Yeah.
And that diversification is central to the defensibility of the business. Their revenue structure, it's a calculated mix. You've got variable volume-driven income, and then these stable, predictable income streams.
Okay.
The largest component, naturally, is transaction fees. This is the core engine, right? Directly linked to market activity, measured by average daily volume, or ADV.
ADV.
Right. So when markets are active, volatile, or require extensive hedging, Tradeweb benefits directly from that increased volume. But the trading business, by definition, it's cyclical, right? If we hit a prolonged period of calm, doesn't that transaction fee revenue expose them to significant downside? We've seen that happen in parts of the market before during low volatility years.
That's a critical point, yeah. And that's exactly why the second stream subscription fees is so vital. This provides the stable cushion. It sort of hedges against those cyclical downturns in transaction volumes.
How does that work?
Well, it's recurring revenue. It comes from platform access and, crucially, proprietary market data. And that real-time and historical pricing data, it's mission critical for clients. They need it for everything: pre-trade analysis, proving post-trade compliance to regulators, all sorts of things.
Okay, so how significant is that stable cushion then in terms of supporting the whole enterprise?
Well, look, it might seem small in percentage terms. In 2024, market data and subscription fees were about 7% of total revenue.
Only 7%.
Yeah, but its predictability is gold. More importantly, this segment provides guaranteed stability. You saw that with its steady 4.1% year-over-year growth in Q2 2025. It's the baseline that kind of stabilizes the whole enterprise and funds that long-term technology development, even when trading volumes might dip temporarily.
So it's the difference between being like a pure trading volume play and being an essential financial technology utility.
Exactly. It makes them stickier. But don't get me wrong, the growth in their core engine is still undeniable. If you look at the Q2 2025 results, a massive 32.7% year-over-year increase in ADV was the primary driver that pushed their total revenue up by 26.7%. So volume certainly drives the top line significantly.
Okay. And then you mentioned a third bucket, which sounds interesting. Emissions and other. This is where they start monetizing maybe newer technological ventures and strategic service initiatives.
Precisely. This includes strategic fees related to these new areas of growth. In Q2 2025, this category actually saw the most explosive growth rate, 31.9%. And a significant part of that new revenue stream is specifically attributed to services they're providing as a validator on the Canton network.
Canton network. How about that?
It's a major digital asset initiative using distributed ledger technology. So it kind of proves their ability to successfully build and monetize infrastructure beyond just, simple bond trading. They're looking ahead.
Interesting. Okay, let's shift to the products they actually trade. You mentioned over 50 products globally. We need to understand the sort of geography of their revenue. What's the massive foundation and what are the highly competitive growth frontiers?
Right. So rates is the foundation. This is their historical stronghold, the massive cash generative bedrock. It was responsible for 52% of 2024 total revenue.
Over half the business.
Yeah. This is where they lead in everything from short-dated U.S. Treasuries and European government bonds to complex interest rate swaps. And even as a mature segment, rates revenue still grew 26.2% in Q2 2025. That was largely driven by record ADV in U.S. government bonds and swaps. So it proves their dominance continues to deepen even there.
So rates is the anchor, prints the cash flow. The narrative then immediately pivots to credit. That seems to be the dynamic growth engine and the center of some intense competitive focus.
Absolutely. Credit accounted for about 27% of 2024 revenue, and this is where management is really pouring resources. Their offerings span the spectrum: investment grade, high-yield corporate bonds, municipal bonds, credit default swaps, CDS.
The whole range.
The whole range. And the push here has been highly successful, which we'll dig into later. But the headline is that Tradeweb finished 2024 as the #1 electronic platform for U.S. high-grade credit by market share. A huge win for them.
Okay, that's significant. And beyond the core rates and credit, we're seeing explosive, albeit maybe smaller base, growth in the emerging sectors.
Yes. The drive for multi-asset trading is definitely paying off. Equities, primarily institutional ETFs and equity derivatives, surged by nearly 50% year-over-year in Q2 2025.
Almost 50%.
Yeah, and look at money markets, specifically repurchase agreements or repo. Revenue here grew by an exceptional 130.7% in Q2 2025.
Whoa, okay, 130%. That can't just be organic market growth, surely. That sounds like it's linked to that acquisition you mentioned, ICD.
Correct. That massive spike is a direct result of the strategic acquisition of ICD, Institutional Cash Distributors, which brings us neatly to their critical multi-channel client network. It's not just one type of client.
Right.
Their core client base has always been institutional, the massive asset managers, hedge funds, sovereign wealth funds. They also serve the wholesale market via Dealerweb, which caters to interdealer trading. That business was strengthened by the eSpeed acquisition back in 2021.
Okay.
And they operate a retail channel, Tradeweb Direct, which is for financial advisors and RIAs.
But the newest, and you could argue most strategic channel, is the corporates channel, created by that 2024 acquisition of ICD. This feels like more than just acquiring another revenue stream.
Oh, it's potentially transformative. ICD immediately brings corporate treasury professionals onto the Tradeweb platform for the first time. These aren't asset managers. They're the people managing a company's day-to-day working capital.
Right, different user base entirely.
Completely different. Their focus is cash management and short-term investments, things like money market funds. Critically, this creates a completely different, often less cyclical revenue stream because, corporate treasury functions are operational necessities, regardless of market volatility. They have to manage their cash.
And we keep hearing this referred to as their Trojan horse. Let's maybe explain what that means in practical terms for you listening.
Yeah, the Trojan horse concept basically suggests the initial entry point cash management is a low-risk, high-stickiness way to get access to these really high-value corporate customers.
Okay.
So once a corporate treasurer is using the ICD portal for something pretty basic, like placing money market fund orders, they are already integrated into the Tradeweb ecosystem. They're on the platform.
So what's the cross-sell then? What happens next? How do they leverage that?
Well, the cross-sell opportunity is immense and immediate. Tradeweb immediately launched T-bill trading and other short-term government instruments directly on the ICD portal. So a corporate treasurer who previously used the platform only for money market funds is now essentially a captive audience for higher margin products that are essential for hedging, like FX swaps, interest rate derivatives. Furthermore, they become a primary relationship for things like corporate bond issuance down the line. It potentially transforms Tradeweb from just a trading venue into a more integrated corporate finance platform. It significantly expands the addressable client wallet share without maybe facing those intense competitive price battles you see elsewhere.
That makes a lot of sense strategically. Okay,
Yeah.
so this whole business model is built on this one simple massive trend, the irreversible tide of electronification, as you called it. To really understand the opportunity here, we have to appreciate the sheer scale of the addressable market. I find the size of the fixed income market almost impossible to truly grasp sometimes.
It is staggering. Yeah, let's try to put it in perspective maybe. Consider just the U.S. fixed income markets. The outstanding Treasury securities alone, so just U.S. government debt, totaled $27.8 trillion at the end of 2024.
27.8 trillion.
Trillion. And that's just U.S. government debt. Before you even start adding agency bonds, corporate bonds, municipal bonds, the entire global derivatives market. I mean, this is the largest, deepest pool of capital in the world.
Wow.
And it is now undergoing this irreversible structural transformation.
And that structural shift is the migration from, well, manual voice-based trading, literally picking up the phone, calling a dealer, to efficient digitized execution. We often hear that fixed income is maybe around 70% electronic now, but there's still a significant runway left, right?
Right.
Where is the real growth potential?
Oh, there's significant runway left, definitely. And the complexity increases the closer you get to 100%. The overall ceiling is often estimated around 80%. The remaining 20% being, the most complex, the bespoke, the really illiquid trades. But that 70% figure, it's kind of misleading because that average figure varies wildly by asset class, and that's where Tradeweb's opportunity really lies.
Right, let's break down those low penetration rates, because they truly illustrate the magnitude of the future growth. It's easy to assume the market is all modern and electronic, but the reality seems quite different in pockets.
It really is. Look at U.S. investment-grade corporate bonds. They're only 48% electronic. Now, that's up sharply from maybe 20% a decade ago, sure, but it still means over half of that market is transacting manually. Phone calls, chat messages.
Still over half, okay.
Yeah. And U.S. high-yield bonds are even further behind, only 32% electronic, even though, again, that's up from a mere 6% back in 2015. Still a long way to go.
Wait, let me just pause on that. Even after decades of technological progress and this huge push from institutions for efficiency, highly complex products like municipal bonds are still only 18% electronic. That's kind of hard to fathom. It means the vast majority of these transactions are essentially still managed via email, chat, and phone calls.
It's true. Municipal bonds are just 18% electronic, largely due to their bespoke nature and the fragmentation of that market. And globally, the opportunity is even larger. In key growth frontiers like Asia and emerging markets, electronic penetration in some local currency bonds is estimated to be as low as 5–10%.
5 to 10%?
Oh,
wow.
This is the deep, wide pool of future growth that Tradeweb is clearly targeting.
So why is this adoption happening now, and why do you say it's truly irreversible? What are the key, powerful driving forces pushing traders off the phone and onto a keyboard?
Well, the first and most obvious force is just efficiency and cost reduction. I mean, automation eliminates manual errors, it speeds up the entire workflow from pre-trade analysis right through to settlement, and crucially, it reduces those back-office administrative costs.
Right.
It's simply cheaper, faster, and less error-prone to trade electronically, especially at scale. Every percentage point saved in operational costs goes directly to the client's bottom line.
Okay, efficiency. What else?
The second force is the value of transparency and data. When you trade electronically, you generate clean, structured data almost immediately. Before electronic trading, this data was often just locked away in chat logs or someone's memory, making it pretty much useless for analysis.
Right, unstructured.
Precisely. This generated data is critical for everything that defines modern institutional finance. Pre-trade price discovery, post-trade transaction cost analysis, or TCA,
yeah.
and fueling systematic and algorithmic strategies. If you want to run an algo, you need reliable real-time data feeds, and only electronic platforms provide that consistently. The data itself becomes a valuable product.
And we absolutely cannot discuss this shift without talking about the heavy hand of regulation. Post-crisis reforms were arguably the biggest catalyst, weren't they? Moving traders from it being an optional economic benefit to essentially a mandatory compliance requirement.
Oh, the regulatory imperative has been profound. Absolutely. Post-crisis reforms like the U.S. Dodd-Frank Act and the European MiFID II framework. They mandated that standardized OTC derivatives and many cash bonds had to be traded on transparent electronic venues, like swap execution facilities or SEFs.
SSF, right?
But the real kicker, especially with MiFID II, was the introduction of these really stringent best execution reporting requirements.
Ah, best execution. That requirement changes everything, doesn't it? If an asset manager has to prove to regulators that they got the absolute best possible price for their clients,
Yeah.
trying to manually log every quote they solicited over the phone becomes a nightmare, both cost and liability-wise.
It becomes almost impossible to defend in an audit, frankly. The sheer requirement to capture a full, auditable, time-stamped trail of all trading activity transforms electronic platform adoption from, an optional economic benefit into a non-negotiable compliance imperative.
Makes sense.
Tradeweb's platforms generate that trail automatically. So this regulatory push, it creates this powerful, self-reinforcing one-way street for adoption. Once you go electronic for compliance, you're probably never going back to manual.
Okay, that's a huge driver. And finally, let's talk about the future ceiling breaker you mentioned, AI and machine learning. If 80% is the current kind of estimate for electronification, AI is potentially what pushes it toward 90% or maybe even higher.
Yeah, that's the thinking. That 20% that remains largely manual consists of the highly illiquid, large, bespoke block trades, the really complex transactions historically deemed too difficult for electronic execution.
Right.
The logic here is that AI can potentially manage that complexity. Tradeweb's own innovations, like portfolio trading, which we'll get to, have already proven that large-scale, complex transactions can be successfully automated. So, as AI and machine learning get integrated to better predict liquidity pockets, optimize complex algorithms for these illiquid instruments, it should become increasingly capable of executing those large block trades that are currently still reliant on voice brokers. AI could potentially turn the too complex trades into manageable, structured electronic events.
Okay, so Tradeweb is capitalizing on this massive mandated shift. But this is clearly a competitive space. What makes the business so incredibly defensible? Why can't some fast-moving fintech entrant just copy their platform and try to steal their clients?
Well, it really starts with the liquidity network effect. This is the classic self-reinforcing cycle that powers all successful electronic marketplaces, and it serves as probably the highest barrier to entry.
How does that work exactly?
Well, more institutional traders on the platform attract more liquidity providers, the dealers. And more dealers offering prices, in turn, attract even more traders looking for the best execution.
Right, it feeds itself.
It feeds itself. So once Tradeweb reached its critical mass, over 3,000 global clients, 50-plus dealer banks providing liquidity, the platform became exponentially more valuable. A new entrant can't just buy that network. They have to build it node by painful node, which is nearly impossible to disrupt once the incumbent is really established.
Okay, network effect. And I imagine this network isn't cheap to run either. That must demand enormous resources, which is another barrier. Technological scale.
Exactly. Building, securing, maintaining a global, ultra-low latency, multi-asset trading platform that has to operate 24/7. It requires massive sustained capital investment. They employ over 400 specialized technologists.
400 technologists.
Yeah. That cost of entry and the continuous technological debt you have to keep paying down to stay current, it's just too high for all but the most well-capitalized competitors.
But the truly sticky factor, the one that maybe guarantees that recurring revenue you mentioned, is the high switching costs via workflow integration. This sounds like a powerful, almost invisible moat.
It really is the deep integration that makes them so indispensable to many clients. Tradeweb's trading tools aren't just separate external applications people log into. They're often hardwired directly into the client's core order management systems, their OMS, and their compliance software.
Embedded.
Deeply embedded. So if an asset manager wanted to switch platforms, they wouldn't just be changing vendors, they would potentially have to completely re-engineer critical internal compliance, settlement, and trading workflows. That carries significant cost, huge time delays, and, most importantly, potentially crippling operational risk if something goes wrong. They become part of the client's operational DNA.
That makes a lot of sense. Okay, now let's focus on the technological differentiation. The specific moat builders that allow them to actually take market share in competitive areas like credit.
I want to start with something called AIEX. What is that?
Right. Automated Intelligent Execution, or AIEX. It's a flagship product.
Okay.
It allows institutional traders to define complex pre-approved rules, things like price tolerance, minimum dealer responses needed, negotiation time limits, acceptable slippage,
Okay.
and then automate the execution workflow entirely based on those rules. It increases trader productivity dramatically, reduces human error, and it's a key driver for getting systematic adoption, especially in things like the growing fixed income ETF space where efficiency is paramount.
But the real tactical game changer, maybe, in the credit battleground, the reason they seem to be gaining share has been portfolio trading, PT.
Yeah, Tradeweb essentially pioneered electronic portfolio trading for corporate bonds at scale. Previously, if you wanted to trade a large list of bonds, it meant individually calling dealers for quotes on potentially hundreds of different CTUSIPs. Painful process.
Sounds inefficient.
Hugely.
Yeah?
PT allows clients to package hundreds of diverse bonds into a single basket and send them out as the single request for quote, or RFQ. This is absolutely indispensable for massive asset managers executing large rebalancing trades or implementing strategies tied to the boom in fixed income ETFs. It is arguably the primary weapon Tradeweb used to start winning serious credit market share from competitors. And they have other tech too, like this patent-pending thing called net spotting that shows the depth of optimization they're pursuing beyond just standard execution, right?
Yeah, net spotting is a great example of solving a really deeply ingrained operational headache for clients. What it does is it aggregates all of a client's treasury hedges and future positions for the entire trading day, calculates a single net position, and then executes that in one efficient transaction.
Netting it all off.
Exactly. This optimization saves clients potentially massive amounts in transaction costs, and it deepens client loyalty because it solves a costly workflow problem that isn't even really about finding the best price on a single bond. It's about optimizing their entire internal hedging process. Real value add.
Okay, now we arrive at the main event, the credit market battleground. This is the fierce competition against MarketAxess, MKTX. This isn't just a friendly rivalry, is it? It sounds like a direct fight for the highest growth asset class.
Oh, it is intensely competitive. MKTX has historically been the dominant platform in credit, particularly known for its innovation in accessing liquidity, like their open trading protocol.
Right.
But the competitive momentum has been visibly shifting over the past couple of years. And, we should note it's not just MKTX. Trumid is also emerging as a fast-growing credit-focused threat. They reached $8.0 billion in average daily volume back in March 2025, posing a serious competitive risk to both incumbents. It's becoming a three-horse race in some ways.
Okay, so let's drill down on the specific data you mentioned from March 2025, because it seemed to tell a definitive story about this momentum shift. If MKTX was dominant, how far behind is Tradeweb now? And critically, are the trends sustainable?
Yeah, the numbers really do confirm the momentum shift. While MKTX still had a slightly higher total fully electronic U.S. credit ADV in March 2025, it was about $10.4 billion compared to Tradeweb's $9.5 billion. The year-over-year trends are what truly matter for the valuation story here.
And those trends favor Tradeweb.
Decisively, yes. In the U.S. investment-grade credit market, Tradeweb's market share actually grew by 31 basis points year-over-year. Conversely, MKTX's market share declined by 9 basis points over the same period.
Okay, so Tradeweb gaining, MKTX slipping a bit in IG.
Exactly, which suggests that the flow, the volume, is favoring Tradeweb's execution protocols in that core credit market.
And the high-yield numbers, I gather, are even more stark, suggesting maybe Tradeweb's technology is particularly effective where liquidity is most challenging.
Much more pronounced, yeah. In U.S. high yield, Tradeweb's share surged by an impressive 133 basis points to reach 7.6% of the electronic market.
Wow, big jump.
Big jump. Meanwhile, MarketAxess's share actually fell by 20 basis points, down to 12.5%. This really demonstrates clear strategic success for Tradeweb's focused expansion, powered by their technology like portfolio trading. They are gaining ground where the runway is longest and where their systematic, efficiency-focused approach seems to be most valued by clients.
So this intense competition, it can kind of be distilled down to a protocol war, right? The two firms seem fundamentally optimized for different types of trading behavior.
That's a perfect way to frame it, yeah. MarketAxess historically excelled with open trading, which is an all-to-all protocol. It was designed to tap latent liquidity, particularly great maybe for sourcing liquidity on a single hard-to-find bond. They serve that locator need really well.
Right.
Tradeweb, however, coming from that very systematic high-volume rates market, excels in scale and efficiency. Their portfolio trading and advanced request for quote RFQ protocols are optimized for systematic, large-scale execution think bulk trading, portfolio rebalancing, ETF creation redemption.
So as the financial world moves more towards systematic, ETF-driven, large basket trading, Tradeweb's efficiency-based protocols are simply a better fit for the institutional money flow that's driving the most growth in credit right now.
Exactly. The segment where Tradeweb seems to hold the technological advantage, scale, automation, efficiency for large lists appears to be the segment growing faster overall in credit. That gives them a kind of structural tailwind in this competitive battle.
Okay, so Tradeweb is clearly not just resting on its laurels here. Beyond the competitive wins in credit, they seem to be making aggressive strategic moves to secure future growth. The ICD acquisition in 2024, the Trojan horse, is the most immediate example. Let's expand a bit on the potential long-term impact of this move.
Yeah, the ICD acquisition is potentially foundational because it completely shifts the composition of their client relationships in a new direction. As we touched on, it immediately opens up the corporate's client channel, a whole new demographic for them, these treasury professionals responsible for managing billions in short-term cash.
And that brings in stable operational revenue.
Exactly. Stable operational revenue, distinct from the sometimes wild volatility of capital markets trading.
And the cross-selling potential is what makes it so strategically valuable, right? Once they have that operational relationship, they can try and sell them everything else.
Right. It's a classic land and expand strategy. They bring in a corporate treasurer for maybe lower margin, high volume cash management products like money market funds. That establishes the relationship, the technology link gets set up, the workflow integration happens. And then they can try to cross-sell higher value financial products the treasurer also needs. T-bill trading, FX swaps for hedging international revenues, interest rate derivatives to manage corporate debt exposure. It aims to transform the relationship from just a transaction-based link to a more strategic operational partnership.
Yeah, that sounds like a textbook example of expanding the client wallet share through a strategic, maybe less cyclical entry point. Okay, so beyond M&A, the company is also showing clear AI leadership to try and push that electronification ceiling higher.
Yes, the appointment of Sherry Marcus as their first dedicated head of AI back in May 2025, that was a very concrete strategic signal. It shows they view AI and machine learning as central to their future success. And their focus isn't just on, chatbots or something simple.
Right.
It's on leveraging machine learning for sophisticated pre-trade analytics, things like predicting liquidity pockets for illiquid bonds and writing more intelligent execution algorithms.
So this is really about solving that illiquidity problem that has historically kept that remaining 20% or so of the market voice traded.
Precisely. If an algorithm can look at dozens of historical factors and predict with high accuracy where a buyer or seller for a specific obscure municipal bond might appear at a given time, well, that de-risks the trade for the market maker, making it more feasible to execute electronically. AI is potentially the tool that unlocks that next, most complex tranche of fixed income assets.
And they're also making sure they're positioned in the, well, still nascent world of digital assets. Highly speculative, maybe, but potentially transformative future market.
That's right. By co-leading a fundraising round for Digital Asset, that's the technology company behind the Canton Network, back in July 2025, Tradeweb is ensuring they are right at the institutional forefront of distributed ledger technology, or DLT application.
So future-proofing.
Essentially, yeah. They are ensuring that if or when the institutional world starts settling bonds or derivatives on DLT networks, Tradeweb already has the established infrastructure, the connectivity, the relationships to capture those flows immediately. It's about not getting left behind if that shift happens.
Okay, all these aggressive strategic moves, the credit expansion, ICD, AI, DLT, they need to be connected somehow. Let's summarize how this all feeds into what you called the self-reinforcing loop, the growth flywheel strategy.
Yeah, the flywheel concept is pretty elegant because each success powers the next step.
Yeah.
So the dominance in the mature rates business generates substantial high-margin cash flow.
Okay, the cash cow.
The cash cow. That cash funds aggressive investment in the credit platform, building tech, hiring salespeople to drive market share gains there. The success in credit then proves their multi-asset capability, which enables strategic, accretive M&A, like the acquisition of ICD.
Right.
ICD then opens up entirely new client channels, the corporates, and to those new channels, Tradeweb can then efficiently cross-sell its high-margin core rates and credit products, plus new offerings. This whole expansion strengthens the overall network effect, makes the moat even deeper, and generates more cash to reinvest, repeating the cycle all over again.
A virtuous cycle. Ideally. Okay, this sounds like a pretty ideal business model. High growth, high defensibility. Let's turn to the financials because for a company focused on infrastructure and technology, the numbers do look exceptional and they really highlight the immense scalability you mentioned earlier.
They truly are the definition of a scalable network business. Their revenue growth is robust and broad-based. It was 29% in 2024, and they maintained high double digits with 26.7% year-over-year growth in Q2 2025. But the real story, I think, is the margin profile. It's just staggering.
That gross margin figure, 94.2%, that's almost unheard of outside of pure software, isn't it?
Mm.
What does that mean in practical terms? Why is it so high?
Well, it really highlights the capital-light nature of their platform. They are essentially a network and a technology interface. They don't hold any physical inventory. They don't take principal risk. And the incremental cost of processing $1 more billion in trading volume is negligible.
Almost zero marginal cost.
Almost zero. So they operate at this massive 94.2% gross margin. That incredible scalability translates directly into extreme profitability, resulting in a strong adjusted EBITDA margin of 54.2% in Q2 2025. When new volume hits the platform, almost every dollar drops straight to the bottom line.
And this high scalability also makes them a phenomenal cash flow machine.
A powerful one, yeah. They generated $952 million in free cash flow, FCF, over the last 12 months leading up to that report. And critically, this business is not CapEx hungry. Their capital expenditure needs are only about 10% of their cash from operations.
Only 10%.
Yeah, which means the vast majority of cash generated is truly free cash flow, available to be deployed for growth, strategic M&A, or shareholder returns. And their balance sheet, it's pristine. They hold $1.6 billion in cash and equivalents and have a very conservative, almost negligible debt-to-equity ratio of 0.2%. Very strong financial position.
So how is management using all that firepower then? What is their capital allocation philosophy? Are they just hoarding the cash or?
No, definitely not hoarding. Reinvestment is clearly priority number one. And the increased investment guidance they gave is a really critical signal here. The company actually increased its expense guidance for 2025 up to a range of $1.0 billion to $1.05 billion.
Wait, they increased expenses?
Yeah.
In a high-margin business like this, that sounds like it could be a potential drag on immediate profitability. Why would the market view that as a positive or a bullish signal?
Because it shows they are aggressively pressing their advantage. That increased expense budget is explicitly earmarked to accelerate investments in credit technology, AI development, digital assets integration.
Investing in the future.
Exactly. Management is stating very clearly, we see massive growth opportunities ahead, we have the cash to pursue them, and we are willing to potentially reduce short-term reported earnings slightly to maximize our long-term market share and technological leadership. It suggests they have high confidence in achieving a superior return on invested capital, ROIC, from these investments compared to just, say, buying back shares or paying a huge dividend right now.
Okay, so reinvestment first. Priority 2 seems to be disciplined M&A, which we saw with ICD and eSpeed. And priority 3 is shareholder return.
Yes, primarily through a consistent growing dividend. They increased the quarterly dividend by 20% to 12 cents per share in Q2 2025. However, and this is important, the dividend payout ratio is still very conservative, only about 16.8% of earnings.
Pretty low payout.
Very low.
Yeah.
And that conservative payout ratio just reinforces the message. Management strongly favors reinvestment where they believe they can earn a much higher ROIC through strategic growth initiatives, rather than simply returning cash to shareholders today. Growth first.
Okay, this brings us inevitably to the elephant in the room, valuation context. When you discuss the PE ratio, we are definitely talking about a stock trading at a significant premium.
We must be clear about the valuation, absolutely. Tradeweb trades at a high PE multiple. It was around 41, 42 times trailing 12 months earnings, and maybe around 32 times next 12 months forward earnings estimates. That is a premium valuation, no doubt, usually reserved for high-growth tech companies, not traditional financial services firms.
So how do you justify that premium then? Why isn't this simply an overvalued stock waiting to correct?
Well, you really have to compare it directly to its peer group, especially its main rival, MarketAxess. The argument is that this premium is justified by its superior defensible growth trajectory. Let's just look at the growth comparison. Tradeweb's last 12 months revenue growth was nearly 29%.
Almost 30%.
Almost 30%. Compare that to MarketAxess, whose revenues were actually contracting by about 2.5% over the same period.
Negative growth for MKTX.
Okay. And they are also growing significantly faster than the more mature exchange operators like CME Group or ICE. So The market seems to be pricing in two key things. One, the demonstrably superior growth rate, and two, the fact that Tradeweb is visibly winning that crucial competitive battle in the credit market. The momentum is with them.
So the risk here isn't really a catastrophic business failure. The technology and the network seem too entrenched for that. The risk is purely related to valuation then.
Precisely. The core business is highly stable, highly profitable. The risk lies entirely in valuation contraction, that high multiple collapsing if their growth rate were to decelerate significantly. Because the market expects high double-digit growth to continue, any sign that they are failing to sustain those aggressive market share gains, or maybe if they fumble the AI integration or the ICD cross-selling, that could punish the stock price severely, even if the underlying business remains highly profitable. They really must continue to execute flawlessly to justify that premium multiple. Hashtag tag tag outro.
This has been a truly fascinating deep dive. Let's try to synthesize the core value proposition here for you, the listener. Tradeweb Market seems to be fundamentally a high-quality technology company that sits right at the nexus of this powerful, often regulation-mandated structural shift toward electronic trading in massive markets. Their business appears protected by high switching costs due to that deep workflow integration and a powerful network effect. And they are actively using what seems to be superior technology to win the competitive battle in the highest growth asset class right now, which is credit.
And it's worth adding, the governance seems stable and highly aligned with long-term shareholders. The CEO, Billy Holt, he's a 20-plus year veteran of the company, which ensures strategic continuity. And remember, his compensation structure is heavily weighted toward performance, 95.5% variable payback in 2024. That means management is directly incentivized to deliver long-term, high-quality growth, not just short-term bumps.
Right, alignment matters. Now, we've seen how the current macroeconomic volatility, the rate shifts, the constant need for hedging, how that has actually been a massive tailwind for Tradeweb, contributing to those record earnings and volumes we discussed.
Yeah, volatility has been their friend recently.
But as we close, there is one critical question that remains, I think. A provocative thought, perhaps.
Okay. If the global market were to, say, stabilize significantly, if central banks settled into a much more predictable pattern and we entered a prolonged period of unusual kind of low volatility hangover, that inevitably reduces transaction fee revenues across the board.
Right.
Will the structural gains that Tradeweb has locked in, combined with those strategic acquisitions like ICD and their heavy investments in AI integration, will that be enough to maintain the strong double-digit growth required to support the stock's premium valuation?
That's the key question.
That really is the critical data point you need to monitor going forward. The future success and the stock's performance, it isn't just about how much volatility exists day to day. It's about whether their technology and strategy are fundamentally transforming the entire market structure, making electronification the default, even when things are quiet. So keep an eye on those electronification penetration rates, particularly in areas like municipal bonds and high-yield credit. That's where the proof of their long-term structural transformation really lies.